Grover, what's this latest tax increase that the Democrats have proposed this week?
Well, you're quite correct in suggesting this is the Democrats' tax increase this week. Now they're talking about taxing private equity investment firms. In the last 6 months, they've talked about taxing tobacco, they've talked about raising taxes on capital gains taxes, on dividends, on gasoline, on the energy that's used to heat your house or run your air conditioning. So they've been rolling out a whole series of different tax increases, and the most recent tax increase that the Democrats in the House and Senate put forward are two different tax increases often talked about in the same breath, taxing private equity investment firms. So the very people who go into the market, buy a company, and improve it and then sell it on the open market. They want to tax the capital gain involved there as if it was normal income, taking a tax rate of 15% and taxing that capital gain at as high as 35%. And then there's another one where they want to tax the passive pass-through investment firm at 35%. So you'd be taxed when you earn it, taxed when it passes through the private equity partnership, and then taxed again when you recognize either capital gains or personal income. So some of these tax rates would be up about 50% when you add them all together. It looks like it's a small tax increase, but it's actually a very significant tax hike.
So why should ordinary people care about this tax increase? Doesn't this just affect people on Wall Street?
Well, it doesn't just affect people on Wall Street. If you own shares of stock, if you have a 401k, an individual retirement account, if you own individual shares of stock, you want the most efficient stock market you can get. You want people out there saying the value of that stock is depressed because management is running it into the ground. We will buy it at its low value, improve it, and then sell it at a high value, which makes money not just for the private equity firm or the investors who put it together, but for everybody who owns shares of stock as the value of stocks increase. So the tax on private equity that you'll hear talking heads talk about is a tax on your 401k, a tax on your IRA, a tax on your retirement. And if you go to University of Michigan or Harvard or Yale, it's a tax on the endowment of those universities, of all charities.
Is this really an assault on the 15% capital gains and dividends tax rate?
At the end of the day, the modern Democratic Party, the guys who run the House and the Senate right now, would like to raise the capital gains tax 15% up to the personal income tax 35%, just as they have done successfully on the corporate level. One of the tremendous successes during the last several years has been in 2003, when the capital gains tax was cut from 20% to 15%, and we saw a tremendous jump in the amount of capital gains realized in capital gains revenue, tax revenue to the federal government. So this is an effort, the beginning of an effort, to tax all capital gains as if it was normal income and raise the tax from 15 to 35%.
If people want to contact their congressmen and senators on this, how can they do so?
Well, at Americans for Tax Reform, we consider this tax increase to be very, very damaging to the economy, and we're running a full-court press of opposition to raising taxes on private equity and private equity investment. At our website, www.atr.org, you can go there and click on for action alerts, and it'll help you write a letter to your congressman, your senator, to send in an email letting people know that you don't want these taxes on your pensions to go forward. That's our website, Americans for Tax Reform's website, atr.org.
Thank you very much, Grover.
Thank you.